Thank you for tuning in to another edition of the Vulcan Report. We are getting right into the InPlay report here. As you take a look, you'll see those securities highlighted in green versus the securities highlighted in red here at the bottom. You'll note that we are still consolidated across the board in the stock market. The S&P, the NASDAQ, and the Dow still have yet to determine a direction. We do still have quite a range that we're oscillating within between support and resistance. That is a wide range that was established from May the 6th. So the range going back from May the 6th is still in play. We still don't have a clear direction yet, and the markets continually gap down or gap higher on the open based on the overnight futures market activity. So trying to catch and play those intraday ranges like that can be a little cumbersome for those of you who are actually attempting to day trade. That's one of the reasons why day trading in this current market environment is very difficult, and I would highly discourage it. I would more rather use swing trade, which is the way I design the system. The algorithms take into account those gap down and gap up days. Now, when you're in a consolidated range pattern like we're doing in the stock market right now, the best thing you can do is to keep out of it. You want for the market to pick you up and take you along for the ride. So if we do break out bullish in stocks, you want to have your orders working in such a way that the market will pick you up and take you along for the ride. Conversely, if the market's going to crash below support, you want to have your orders working in such a way that it picks you up and takes you along with it for the ride to the downside. Alright? With that said, I've gone through great pains to make this as simple and as easy as possible so that even the rookie, the beginner, can follow along. It's not that difficult. It's not rocket science. I've taken all the guesswork out, all of the econometric modeling, all of the fundamental news and analysis. Everything that can be known about the security is already factored into the price of the security. And I've taken great pains in programming that for you so you don't have to be glued to the computer or glued to your television set watching the local media. Alright, with that said, another thing I want to caution you with is patience. This is not a casino. This is not gambling. This is not the blackjack table or the roulette wheel. Okay? This is trading. It's investing. It's taking a speculative approach to the markets. So you have to wait for patterns to materialize that are going to give you substantial profits. Okay? So we take managed risks, well calculated managed risks based on our prospective returns. So you don't want to get into a habit of chasing the market. If the Dow is down 170 points on the open, you don't want to be short on the open because it's going to fill you at the low of the day, and then it's going to retrace and stop you out. You don't want that. Alright? You don't have to chase these markets. All you have to do is be patient, and the profits will take care of themselves. Take the emotions out of the market. It doesn't matter what you think the market should do. It only matters what the market does. Okay? We take what we get. You also don't have to be afraid of missing some moves. Okay? if you miss a move, it means it wasn't meant for you to be in that move anyway. And you can always wait to catch the retracement or the reversal. Or if it's going to be a continuation pattern, you can get in on the following subsequent move. It's just that simple, ladies and gentlemen. You don't have to panic. You don't have to worry. There's plenty of money on the table each and every day. All right. I'm off my soapbox. Please make a note of the things that we have highlighted here in green. Right now, I'm putting on the InPlay list the Forex currencies and the eMini S&P, eMini NASDAQ, and eMini Dow Jones futures contracts, and of course stocks, which consist of their ETF counterparts. That's what we have on here, okay? And from time to time I will put individual shares on the list as well, but for the most part I'm focusing the concentration on the ETFs, the Forex currency pairs, and the stock index futures, okay? So with that said, if you don't see it highlighted in green, it means that we're not looking to buy it for the following trading session. If you see it highlighted in red here, like you see in the bottom of the list, that means we're looking to sell it in the next trading session. If you do not see the pair that you favor on the list, it means that there is no signal for it for the next day. And that could be because perhaps it's consolidated and trapped within the Kumo cloud, and we're waiting for it to break out either way, up or down, before we look to get into it, okay? That's all that means. It doesn't mean that I neglected to put it on there because I didn't feel like it. All right, this is all computer generated, so I don't have to touch it. I just push a button and the system will spit out the information, okay? All right, one thing I want to point out here though is the spot gold. Now you'll notice that spot gold is on the breakout list here, and we're looking for a pulse wave pattern to emerge, and that will be a long pattern, buying long at 1237.17 on the spot. And you're going to put your stop loss here where it says stop loss at 1221.19. Okay, that's what we're looking for. You're also going to want to note when you're looking at this, please pay attention to the positive swing VIX readings. If you have a positive swing VIX reading, which means you're going to have a 1 in this column, you want to take special heed to that. That means that a breakout is imminent to the upside, and you want to be in on that, okay? Likewise, take a look at the sell signal. All right. Whenever you see a sell signal, you want to take heed to that as well. If you see this sell signal column here, it has a 1 there, and the market's in an uptrend, it means that it could be possibly running out of steam and could be ready to pull back. And those pullbacks could be substantial. So, example, you see here where it says sell signal on the JJG, which is the grains ETF. All right, you notice we have a sell signal here, and we have a pulse wave potential pattern here. Okay, the way you would play this is you would go ahead and place your trade to go long at the 41.93 level, and of course you put your stop loss here at the $40.67 level. But you would also place a simultaneous order to sell short, if you can locate the shares, at $40.14, because that's the pulse wave support level, and you have a sell signal here, which means if this is triggered, it could pull back rather substantially. Okay, that's how you would play that. All right, let's see. Another thing I want to point out here is on the bear side. I wanted you to look at the triple ETFs here. You see this one here, the mid cap, which is the S&P 500 equivalent. the bull and the bear. Both of these are in red. And if you scroll over here, you'll see that both of these right now are showing that they are in a downtrend, okay? Which is rather odd because these ETFs are supposed to move the opposite direction of one another. The bull one, the long mid-cap, or long S&P I should say, should be in one trend, and the bear one should be in another. But if they're both in, for a brief time bearish, that means that one is about to pull away from the other one. And if the market wants to roll over, you can expect the bear one to break out and rally in the coming days. But from time to time, you do get a situation like this where you'll have a sell issued on both of them. All right, so you got to pay attention to it. You don't have a choice. If you're going to trade that market, you have to obey the signals there. Another thing I want to point out too is on the ultra short 7 to 10 year bond. You'll notice that that one is an ultra short, and we're looking to actually sell the ultra short. So you could either go ahead and short the ultra short, or if you're long it, you're probably going to want to go ahead and get out and take profit, because it's showing that it's an established downtrend now, and you don't want to be long this unless we get a buy signal. Then of course we'll buy it because it's saying that the downtrend is exhausted. So that's pretty much it on how you use this report. Okay, it's very simple. We see here that the first thing you're looking at when you look at this report, the very first thing you're going to look for is to see if you have a buy, because it's green. So the first column here is the breakout long. If there's a 1 here, then you're going to look at the buy entry price, and you're going to go ahead and enter a stop limit to buy that. All right. The next column you look at is the pulse wave breakout column. The pulse wave breakout means that a possible pulse wave is developing where the market is either going to break out or break down. Normally in a bull market, the market will break out from that resistance zone. But sometimes the trend can be exhausted, and for whatever reason, it will break down past the pulse wave support. So you could actually put in an order to sell at the 40.14 on this one, and long at the 41.93. And when the other one gets filled, that's the one you go with. And you can even use the opposite as your stop loss to trail the position, if that makes any sense. I've really taken all the guesswork out of it for you and made it very simple. Okay, so the breakout long is the trade letting you know that you're going to take the buy. If you see a pulse wave, you're going to take this signal here and then this one over here. It's really quite easy. Again, I've taken all the guesswork out of it so that you guys can really have an opportunity to make some money, and you don't have to bash your head against the wall or try to chase the market. Okay. So if you have any questions, just send me a message or whatever, and I'll do my best to get back to you and answer all your questions. But again, I try to make this as painless as possible. Please be patient and allow the market to come to you. You don't have to chase the markets. You have opportunities to get in and get out every day. But in a consolidated phase like we've had lately, I know that it can be frustrating when you're waiting for some action and you can't get any because the markets really aren't doing anything. And that's cool. You don't want to be one of those 95%ers who chase the markets and think they have to get in every single day, and they get chopped to pieces. Don't let the banks take your money. It's time to drain the banks and take back your money. Take what you can, give nothing back. Peace out.